Ever gazed at those stunning photos of beachfront villas or sleek, modern condos in a place like Phuket, Thailand? It's easy to fall head over heels for the idea of owning your own slice of paradise there. But, once you've picked out that dream property, what happens next? What are the practical realities of turning that beautiful vision into, well, a truly sustainable investment? Today, we're taking a deep dive into exactly that, demystifying the ownership structures and tax rules for foreigners looking at real estate in Phuket. Because while the allure is undeniable, the legal and financial landscape definitely requires some careful navigation.
Yeah, absolutely. Our mission today is really to cut through the noise and extract the crucial nuggets of knowledge you need from our source material. We want to arm you with clarity, help you understand what's truly involved, maybe avoid some common pitfalls that can trip up even experienced international buyers, and ultimately empower you to make truly informed decisions about property in Phuket.
And this deep dive is based on an incredibly insightful guide titled Phuket Property Taxes, a Foreigner's Guide. It comes to us from Ocean Worldwide, a luxury real estate agency based right there in Phuket since, wow, 2004. They've apparently been helping thousands of families and investors over the years. Their director, Sandra O'Neill, is deeply involved, focusing specifically on luxury residential real estate in Phuket and Koh Samui. So they really know this landscape inside and out. Let's pull back the curtain. Okay, so having envisioned your dream home, the first real hurdle is understanding how you can even, put your name on a deed in Thailand. It's not quite as simple as buying a house back home, is it? I hear direct foreign ownership of land generally isn't straightforward.
That's absolutely the foundational point, and it often surprises people. Look, while owning land outright as a foreigner is largely restricted, Thai law offers specific, well-established pathways. Probably the most common and accessible entry point is freehold condominium ownership. Here, you can actually own the individual condominium unit like the four walls of your apartment outright. It's full, direct ownership of that specific unit.
Okay, that sounds pretty clear-cut for a condo. But what's the catch, if there is one? I imagine it's not quite the same as owning a freehold house in, say, London or New York.
You're right to ask. There's a key distinction. While you own the unit directly, the land it actually sits on is typically owned by a Thai company. This is a common and perfectly legal setup. But another crucial point is the legal limit. No more than 49% of a condominium building's total floor area can be foreign-owned. This isn't just some obscure rule. It actually shapes the entire market. It's why condos are often the most accessible entry point for foreign buyers.
Right, that 49% cap is a fascinating detail. But what if someone's dream in Phuket isn't a condo, but maybe a sprawling villa with a private garden, or even just a plot of land to build on? Does that open up a whole new set of rules?
It does, yeah. For standalone villas or land, foreigners typically enter into leasehold agreements. This means you're essentially leasing the land for a long period, usually 30 years. And typically, there are options for renewal built into the contract, often for another 30 years. Under this structure, you own the physical building, the villa or house that sits on the land, but you are leasing the land itself. Having a really meticulously drafted lease agreement is absolutely vital here to protect that investment over the long term.
Okay, so leasehold for villas, what else? Is there another way?
There is. The third common route, especially for landed property, is through company ownership. This involves setting up a Thai company which then holds the land. It's a way for foreigners to effectively control land, but look, it's significantly more complex. The critical requirement here, and I really can't overstate this, is that the Thai company must be a legitimate business with a genuine purpose. It cannot merely be a shell company created just for property ownership. If it's genuinely trading, employing people, paying its taxes, then owning land through it is generally fine.
Okay, I've heard whispers about nominee shareholders with this company ownership approach that sounds like a bit of a minefield waiting to happen. Is that as big a red flag as it sounds?
It absolutely is, and it's a critical warning. Thai law requires a certain percentage of company shares to be held by Thai nationals, typically over half. It is absolutely vital that these Thai shareholders have a genuine stake and have actually paid for their shares. Using nominee shareholders, individuals who hold shares just in name to meet the legal requirement, but have no real investment or control, is highly illegal. The authorities can impose really severe penalties, substantial fines, imprisonment, even ordering the dissolution of the company and the forced sale of its assets. So genuine investment and genuine participation from Thai shareholders are paramount. It's not something to mess around with. Wow, okay. So choosing the right door, if you will, to ownership in Phuket is clearly non-negotiable. That structural choice sounds absolutely foundational because, as you say, it directly impacts your tax obligations and legal responsibilities down the line. It really sets the stage for everything that follows. Precisely. And that foundational understanding becomes your first line of defense against potential pitfalls. So once you've picked your structure and found that perfect property, many people just focus on the purchase price. But that's only part of the equation. There are several taxes and fees involved in the property transfer process itself, and these can really add up if you're not expecting them.
Right, this is where the dream meets the spreadsheet, isn't it? Many buyers might think it's just one big transfer fee. But what are the actual line items we're talking about? What will you encounter right at the point of transfer?
Yeah, it's far from just one fee. Let's break down the key property transfer taxes. First, there's stamp duty. This is basically a tax on legal documents, typically 0.5% of the property's registered value. It generally applies when another tax, called business tax, is not applicable.
Okay, stamp duty. What's next?
Then you have withholding tax. This one's a bit more nuanced because it depends on who the seller is. If the seller is a company, it's a flat rate of 1% applied to the higher of the registered value, or the government's appraised value. However, if the seller is an individual, it's a progressive tax. This means the rate changes based on the property's value and, crucially, how long they've held it. Shorter holding periods often incur higher rates.
Interesting. So it depends on the seller. What about this business tax you mentioned? Is that the same as stamp duty or different?
No, it's distinct. Business tax comes in at a rate of 3.3%. This typically applies if the seller has owned the property for less than 5 years, or if it was acquired through a business entity. But there are exceptions. For instance, if the seller's actually resided in the property for over a year, it might not apply. An important point is that if business tax does apply, the stamp duty is usually waived. So you rarely pay both on the same transaction.
Okay, so if I'm understanding this, it's not just one big upfront cost, but several, each with its own rules: stamp duty, withholding tax, business tax. For the typical buyer, which of these are the real heavy hitters? And how do we even know what value these taxes are based on the price we agree or something else?
Well, heavy hitters really depend on the specifics of the transaction, especially the seller's status and how long they've owned it. But all these combined can certainly add up. And to your second point, that's a good question. While the registered value is the official price stated in the transfer documents, taxes might actually be calculated based on a higher assessed value determined by the government, if that figure is higher. So yeah, it's not always just about the price you agree on.
Got it. Okay, so beyond those direct taxes, are there any other significant fees baked into the transfer process?
Yes, absolutely. If you're getting a mortgage to finance your purchase, there's a mortgage fee that's usually 1% of the property's registered value. And then there's the transfer tax itself, which is typically 2% of the registered value. It's probably worth noting for listeners that a government reduction on these fees for properties under 7 million baht, that actually expired at the end of 2024. So for most transactions now, you're looking at the standard rates.
Right. That's a lot of different taxes and fees to keep track of. And the million baht question, maybe literally, who actually pays for all of these transfer expenses? Is it always the buyer? Or is it usually split down the middle? It's a common question, and the answer is, it's often negotiable between the buyer and seller. It should definitely be clearly stated in your contract. However, common arrangements do exist. The transfer tax, that 2%, often split evenly, 50-50. Stamp duty is usually paid by the seller, particularly if they aren't liable for business tax. Both withholding tax and the business tax are typically the seller's responsibility, especially if they've owned the property for less than 5 years. The mortgage fee, though, that's generally borne by the buyer as it relates directly to their financing. The bottom line is, get it all clearly agreed upon in your sales contract and, seek professional legal advice to make sure everything is properly documented and understood.
Okay, makes sense. So you've navigated the purchase, the papers are signed, keys are in hand, feels good. Now, what about the ongoing costs? What are the recurring financial obligations you'll face as a property owner in Phuket? What does annual look like? Right. The main ongoing commitment is the annual property tax. There's the Land and Building Tax Act, which came into effect back in 2020. It replaced older tax laws, and it's what you'll be dealing with now. The tax is calculated based on the government's appraised value of the property, which, again, isn't necessarily what you paid for it. And the rates are variable, depending on how the land is used.
How variable are we talking?
Well, what's fascinating here is that the tax rates are tiered by land use. For agricultural land, rates typically range from a very low 0.01% up to 0.1%. Residential land generally falls between 0.02% and 0.1%, so still quite low for your main home or second home. Commercial or industrial land, however, faces higher rates, usually from 0.3% up to 0.7%. And importantly, vacant or unused land is also taxed at these higher rates, typically in that 0.3% to 0.7% range. The government wants land to be used productively.
So, if I'm picturing a typical residential villa or condo, what's a ballpark for that annual tax bite? Is it significant? And are there any clever ways people minimize this? Like, I heard something about planting a few banana trees to get a lower rate. Is that actually a thing?
Huh, yes, it absolutely is. And there are some significant exemptions worth noting first. For instance, if your primary residence, meaning both the house and the land it sits on, has a total government appraised value under 50 million baht, it might actually be exempt from this tax altogether.
Hmm?
Similarly, agricultural land valued below 50 million bahts can also be exempt. And yes, the anecdote about planting a few banana trees on empty plots, that's done to qualify for the lower agricultural status and potentially avoid the higher vacant land tax. It's a genuine, if sometimes amusing, local strategy. It really highlights how owners can get creative within the existing rules.
That's truly a unique local insight. Love it. Okay, what about if you're planning to rent out your Phuket property? Lots of people do that. How is that income treated for tax purposes, and what kind of records do you need to keep?
Right, if you rent out your property, any rental income you receive is treated as personal income and is subject to Thai income tax. The specific rate you pay will depend on your overall annual income bracket in Thailand. It's incredibly important here to keep accurate records of your rental income and also any allowable expenses, things like costs of repairs, maintenance, property management fees. These can generally be deducted against your rental income before your personal income tax is calculated. So good record keeping can significantly reduce your taxable income.
And what are these taxes generally due?
Well, the annual land and building taxes are usually due by March 31st of the following year. However, for rental income tax, payments might be due earlier, often by February, depending on how you file. It's always wise to confirm the exact deadlines with a local tax professional for your specific situation, just to be safe.
Makes sense. Okay, so beyond just, surviving the tax system and paying what's due, how do we actually make this property work for us? Both for income now and maybe for appreciation later. It's not just about compliance, it's about strategy, right?
Exactly. To truly maximize your returns, you need strategic planning right from the outset. For rental yields and income generation, you should obviously aim for properties in areas with high tourist or expat demand. Think about proximity to beaches, good restaurants, amenities, transport links. Those high demand periods, like the European winter months, can be incredibly profitable for rentals. Platforms like Airbnb or working with local agents can provide a steady income stream, potentially covering costs and even generating profit.
And what about the long game, capital appreciation?
Yeah, for long-term capital appreciation, properties in desirable areas of Phuket can see significant value increases. The source mentions sometimes 5–15% a year, which is quite impressive growth. To identify these opportunities, you should research areas with a history of property value increases and definitely look into any regional development plans. New infrastructure often boosts values.
That's a compelling growth rate. But what are some of the classic missteps buyers make? What should they absolutely avoid when trying to maximize their investment?
That's a crucial question. A common pitfall is falling for deals that seem too good to be true, because they often are. Cheap properties might be in less desirable locations, maybe with title issues, making them much harder to rent out or sell later on. You get what you pay for, often. And if you're not planning to live there full-time, seriously consider a good property management service. They can handle everything from finding tenants and handling rentals to maintenance and guest relations. It takes a lot of the hassle off your plate and ensures your investment is well cared for, especially from afar.
Good advice. And thinking even longer term, what about passing this piece of paradise on, maybe to family? How does inheritance work for foreigners in Phuket, especially with all these unique ownership structures we've discussed?
This is where succession planning becomes really critical, and yeah, it can be complex for foreigners. One of the most common and, frankly, effective methods for foreigners to manage their Phuket real estate for succession is by transferring ownership through company shares. Remember that company structure we talked about? Instead of owning the property directly, you own shares in the Thai company that holds the property. When you pass away, your heirs inherit the shares, not the property itself. This structure neatly bypasses some of the direct foreign land ownership restrictions, simplifying the process considerably. But again, it's absolutely crucial, as we mentioned earlier, that the company remains a legitimate, active business.
So the company structure serves a dual-purpose ownership now and inheritance later. What else should people consider for estate planning?
Well, for estate planning considerations, it's generally very wise to have a Thai will drafted specifically for your Thai assets. This ensures it aligns with any primary will you might have back home and clearly states who inherits your shares or your directly owned property, like a condo unit. It's also highly recommended to appoint a local executor who is familiar with Thai law and the local Phuket property market. This can make the process significantly smoother and less stressful for your beneficiaries.
Okay. And what if someone does inherit land directly, say from a Thai spouse?
Right. In terms of the legal framework for inheritance, if a foreigner inherits land directly, let's say from a Thai spouse who passes away, they typically have a limited time, usually around 180 days, to dispose of that land to a Thai national. This is a key reason why that company ownership structure, when set up and maintained correctly, is often favored for long-term planning. It avoids these direct land inheritance issues for foreign heirs, allowing your investment to benefit future generations much more seamlessly.
Interesting how that structure keeps coming up. Okay, before we wrap up, there's one more crucial piece of paperwork you mentioned needing to be aware of, especially when bringing money in from overseas. The FET form. Why is this more than just like a bureaucratic checkbox? What does it do, and why is it so important for anyone looking to invest?
Right. The Foreign Exchange Transaction, or FET, form, yes, it's mandatory, and it's issued by the Thai bank receiving the funds. Its primary purpose is for the Bank of Thailand to track the inflow of foreign currency into the country for specific purposes, like property purchases. It helps monitor capital flows, and crucially, it legitimizes the transfer of your funds for that specific purpose.
Okay, so it's not just about getting the money into Thailand, but ensuring you can get it out later if you decide to sell the property. That sounds like a critical detail people might overlook.
Precisely. Its importance for repatriation really cannot be overstated. Without proper FET documentation showing the funds came in for investment, you might face significant issues, delays, or even tax implications when trying to repatriate funds later, for example, if you sell the property and want to send the proceeds back home to your country. It's your official paper trail, proving how the money entered Thailand for this specific investment, verifying its legitimate origin.
Okay, and what info does it typically require?
As for the information required, you'll typically need buyer and seller details, property information including its location and registered value, the transaction amount, and the currency used. Also, the clear purpose of the transfer buying property and supporting documents like the sale and purchase agreement. And while it's not a tax form itself, it's intrinsically linked to tax compliance. It helps prove the legitimate origin of your capital, which can be important for tax purposes down the line, or when dealing with capital gains tax if you eventually sell. It really reinforces the overarching message here. Navigating Phuket real estate successfully requires diligence, research, and crucially, working with reputable professionals, legal advisors, experienced real estate agents like Ocean Worldwide, who understand the nuances of Thai property law for foreign buyers. Honestly, this proactive approach will save you so many potential headaches in the long run.
Absolutely. Getting all that paperwork in order from the very start, it definitely sounds like it saves a lot of potential trouble later on. So, as we wrap up this deep dive, it's clear that owning property in Phuket can be an incredibly rewarding investment, both for your lifestyle and potentially for financial gain, too.
Indeed, it's definitely not always straightforward. There are hoops to jump through, but with the right knowledge, the right advice from professionals on the ground, you can absolutely navigate the tax system and the ownership structures effectively to maximize your benefits and avoid those potential pitfalls. Getting things right from the start, understanding these structures and taxes is absolutely key. Maybe something to think about is this. Consider not just the dream of that beautiful villa or condominium in Phuket, but also the often unseen legal and financial scaffolding that makes that dream sustainable for the long term. How does understanding the local rules, even the seemingly small or quirky ones like, the banana trees, transform a simple property purchase into a truly robust, lasting investment?
That's a great thought to end on. We hope these insights help you on your journey if you're considering owning a piece of paradise in Phuket. Thanks for diving deep with us today.